Shyam Sekhar joins us now, Chief Ideator and Founder with iThought. Shyam, morning. Thank you for joining us. Shyam, for the better part of this year, you were bearish on banks and bullish on IT and pharma. Now, banks are underperforming, IT is outperforming. Now do you think it is the turn for pharma to catch up?
I think pharma will catch up, but it may not come with the kind of speed with IT came back. So because the number of people who are doubting the ability of pharma to come back is very high. So I think too many doubting Thomases have to convert. So I think that is going to take a long while. But pharma will definitely come back because I think they are getting their act together, and they have been doing a lot of things right also. I think in the media and among the analyst fraternity, the greater emphasis through 2017 has been on what went wrong with pharma. I think the time has come to start looking for what is going right. And I think it will be a positive and a virtuous cycle for pharma. So I think pharma is definitely interestingly poised at this point. I continue to remain bullish on that space.
Okay. Now let's be a devil's advocate on IT. TCS numbers are good, but the IT industry is not going to go back to growth of 25, 30, 40%. So I wonder what are markets celebrating? And whereas TCS was good, Infosys was lukewarm, HCL Tech has been so-so, and Wipro came out and gave a profit warning. So if I take TCS numbers out of the equation, not everything is also looking great in IT, but markets are celebrating IT as if a new TMT cycle has started.
Nikunj, to be honest, we sold pharma on the day you were celebrating the $100 billion market cap. I mean, sold IT, I'm sorry. We got out of IT on the day you were celebrating the $100 billion market cap of TCS. From that day, we have sold down our IT positions. The logic is very simple. These are not the longer cycles that you used to see in the past. So you are actually playing for that maybe 20-25% returns, and once you get them, you need to move on and you need to do a little bit of switching, and your portfolio has to be actively managed. I don't see the optimism that people have generated post these TCS results. I don't see too much merit in that. It is again the institutional imperative of money trying to hide in safety. That's all. I think that has been overdone in my opinion, and I'm largely with you on what you are trying to imply.
Okay, fair point. Shyam, morning. You know, the standout thing this morning is not really the GST mop-up or what Urban India has done in terms of their car preferences, what with regards to Maruti sales uptake, which are again very robust. It's about some of the rural consumption trends that we are seeing. If you were to track M&M's numbers, Aisher's tractors performance, Escort's numbers, which have been extremely robust, or for that matter, Dabur, wherein the volume trend has managed to beat all and every street expectation. And given the fact that this year you've got a couple of state elections lined up in the run-up to the big one, the 2019 elections, do you think it's the rural theme which will continue to dominate the market and we will continue to see very strong consumption trends there?
I am bullish on two sectors. I call them a twin bet because they are very closely interconnected. I am bullish on agriculture and I am bullish on consumption. And I think the consumption from the rural side is definitely going to be a positive surprise over the next few years. I think we are at the beginning of a very long cycle. A lot of structural change that happened in agriculture over the last 4 years. In terms of productivity, I think farm productivity has definitely risen, but the productivity has not translated into income. I expect that over the next few years, this productivity gain will translate into income in the hands of the farming community, and that in turn will reflect directly in consumption. You are already seeing it in the tractor sales. It is not an isolated incident. Month after month, you are seeing tractor sales ramping up, and you are going to see a lot of positivity coming from rural consumption, and agriculture is going to be one of the key drivers of consumption going forward. So I think it's a twin bet. They are closely interconnected, agriculture and consumption. I'm bullish on both.
And Urban India as well is not left far behind, Shyam. Not just what we've seen with Maruti sales data, with Titan's numbers, the management commentary, or for that matter, the same store sales figures coming in from Jubilant. And, you know, given the fact that even in the volatile months that we've had in February as well as March, these stocks have been sitting at their top end.
I think urban consumption is a bit overestimated because, see, I think the urban savings potential is not going to expand over the next few years as it has expanded over the past few. So, I think that one should be a bit cautious in taking bets on urban consumption. It should be in pockets. I don't think one should generically bet on urban consumption going higher for the simple reason that there has been very gross misallocation of urban savings over the last several years. And again, I'm not seeing urban savings getting allocated sensibly. This misallocation is going to continue. For example, people are overinvested in real estate. They're not going to see returns for years and years to come. And you are going to pay interest on that. So I think that incomes are not urban incomes are not going to grow at the same rate that they have grown in the past. There is going to be a lot of stress because there is not enough job creation. So I don't see wages inflating in urban India. So I think that urban consumption should be cautiously viewed, and I think that what we pay for buying urban consumption stories should be very closely scrutinized. If you overpay, you are going to experience long time corrections and poor performance. So I think one should be very clear in segmenting urban consumption and rural consumption. While I see a strong case for bullishness in rural consumption, I don't share the same optimism on urban consumption. Yes, you are saying automobile, which is a bright spot, but that has to do with new users coming in and the availability of credit. I think the banks don't have avenues. There's a lot of credit that is getting thrown around, and that is what is leading to a lot of buoyancy in the auto numbers from the urban markets.
Yeah. And that continues. If you go by just the potential of growth there, it still seems, a tip of the iceberg. Shyam, wanted to understand your optimism for the steel sector within commodities. You like steel?
See, I think overall we have been kind of cynical about Make in India and about the structural changes in our economy because they have been very slow. 4 years into the life term of this government, not much is visible on the ground, and that has to do with the structural decay that we had over the last 10 years, the previous 10 years. Between 2008 and 14, you had run down all the core sectors into the ground by very poor lending and all sorts of things. So steel was affected the most because of this. Imports were of the region of 15 million tons. Today, the net import is almost zero. So I think that we are looking at a stage where we have kind of put those problems behind. I think everybody has got linkages, they have got capacities are in the hands of new people, businesses are getting recapitalized, and there is a clear move towards consuming domestic steel rather than importing. So I think that the Make in India initiative and all the changes that has happened over the last 4 years will play out to the benefit of the steel sector over the next 4 years, as you're seeing a massive consolidation and capacity creation, and demand is going to be high single digit, at least, if not low double digit over the next 3 to 4 years. And I think that this is going to directly benefit the steel sector because they have the resources, and the resources are not going to inflate at the same rate at which their demand is going to inflate. So I think that you're going to see a massive operating leverage story playing out in steel. And what you're seeing now is only the first leg of this rally. Post the resolution of all the pending NCLT matters, I think the companies will go into new hands. They will again find working capital, and then you will see the businesses crank up. I think it's a long story, but a great story.
Long story, but a great one. I also want to take a leaf from one of your tweets earlier on, and this might be an extension of your theme, when you're saying that you like consumption, so to speak. You said buying a stock again at a high valuation after it becomes a multi-bagger is hardly easy, but you need to think hard enough and take that call. When does one decide to step out, or does buy and hold for a very long period of time suit this market environment?
I'll just tell you shortly how I would do it so that it can be an easy way to identify also. See, simply speaking, stocks had compounded over the last few years on the agri theme, where the raw material was an agricultural product and somebody was actually adding value, and they are able to generate a ROE in excess of 20%. Number of such companies are there, where the raw material is an agricultural output. In those cases, the valuation had run up to high double digit, probably 25 times, or even some cases 30 times. When the multiples again dropped to something like 17, 18 times and you're still seeing that 15, 20% growth, I think that's an inflection point at which you start trying to look at that idea afresh, as if you are looking at it for the first time. When you look at it in that way, you look at it on the merit of its current valuation. I think many of the stocks which we have possibly bought years ago, again when they come to 17, 18 times, and they are again looking strong to grow at 15, 20% for the next 2 to 3 years, they would again become undervalued, and the time correction which you will see in those stocks will end sooner than we expect. I think those stocks can be bought. I think the agri value chain is something where the opportunities will still coming back to us during corrections, and now the corrections are happening. I think these should be viewed positively as an opportunity to re-enter these stocks or to again add to existing positions. That is how I look at buying stocks at a higher level. It should be as if it's a new position, but look at a multiple of 17, 18 times if you're getting 15 to 20% earnings growth, because in 2 years, again, the stock would be giving you returns, if not in the immediate year that follows. So I think that there is a fair opportunity. Assume that you bought it at 17, 18 times and the stock again falls to 14, 15 times. That only makes it all the more attractive to buy more. So essentially, you are going to have an incremental conviction play which you are going to work out on. And that's a good way to buy stocks again at higher levels.
Simple follow-up question. For the longest time, all of us have argued HDFC Bank is a mega stock, expensive, everyone owns it, it's priced to perfection, there is cheery consensus, don't buy it. For last 3 years, I guess we've made arguments on various forums that ICICI Bank is cheap, it's sub 2 times book, it cannot fall more. But for those who bought an HDFC Bank 3, 4, 5 years ago versus ICICI Bank 3, 4, 5 years ago, irrespective of the underlying promise of valuations, the money is being made in HDFC Bank. So do you think somewhere we must recognize that we should not get carried away by lofty P multiples and big, big price to books, just focus on growth, and wherever there is growth, just go for it?
See, I think ICICI has suffered a decade of leadership crisis, and I expect this to end very soon. I think the situation has become untenable. On the other hand, HDFC has had a very benign, reward from very decent leadership. And actually what we have done is you have overestimated the leadership virtues of HDFC Bank, and we have underestimated the business position of ICICI Bank. I think these two should converge over time, and you are going to see valuations converge over a period of time, but that will start only when the leadership crisis in ICICI Bank is settled. And I think that going forward, it may not be a bad idea to look at ICICI Bank after the full year results are out. I think one should wait for that, and then you can take a fresh look. I am not pessimistic, because what ICICI Bank has built over the last decade in the retail side will start getting valued better, be it the AMC, the insurance plays, or the ICICI Direct, all these, the securities business. I think all these are very, very strong franchises, and they are all suffering because of the leadership crisis in the parent. I expect that the leadership crisis in the parent will be settled. ICICI deserves a better board. When they get a better board, I think the stock will get re-rated. And I would not be cynical or pessimistic at this point in time. We have already gone through a decade of leadership crisis, and it is imminently ending.
Okay, Shyam, always great to get in your wisdom on the markets. Good speaking with you.
Thank you.